Did you just get a surprise bill from the ATO for Division 293 tax? You lodged your income tax return, received your notice of assessment, possibly even paid your tax bill and thought it was done and dusted. And now you just found out that you have to pay an additional tax on your super contributions. You're certainly not alone in this situation. My name is Elena. I'm a tax advisor at Prism Accounting. Today, I'm going to cover everything you need to know about Division 293 tax. Division 293 tax is an extra 15% tax imposed on your concessional super contributions if your adjusted taxable income in a particular year exceeds the Division 293 threshold, which is currently $250,000. I should emphasize that it is based on your adjusted taxable income. To calculate your adjusted taxable income for Division 293, you have to start with your taxable income as shown in your tax return. Then you have to add any reportable fringe benefits, for example, if you're salary packaging. You also need to add back any loss you made on negatively geared investments and rental properties. There are some other adjustments that would only be relevant to some taxpayers that you can see on the screen. But most importantly, you need to factor in your concessional contributions themselves. Your concessional contributions will generally include any super contributions made by your employer, including super guarantee and salary sacrificed amounts, any super contributions paid under sessional VMO contracts, and any personal contributions which you claimed as a tax deduction. Division 293 tax is calculated as 15% of your concessional super contributions in excess of $250,000 threshold. So if your adjusted taxable income before super contributions is below the threshold, but when you add the contribution it goes above the threshold, you only pay tax on the spillover amount, not on the full amount of the contribution. Let me show you an example. Let's say your taxable income shown on your income tax assessment is $200,000. You have a job with a public hospital and your salary packaged up to your $9,000 limit, which gives you a gross staff fringe benefit amount of $17,000. In your tax return, you declared $20,000 of rental property loss, which you have to add back. In that year, you also had concessional contributions consisting of employer super guarantee and personal contributions of $27,000. So, your total adjusted taxable income comes to $264,000, but if you exclude super, it is only $237,000. Division 293 tax only applies to your contributions above the threshold, so you don't pay the tax on the first $13,000 that gets you to the $250 mark. You only paid on the remaining $14,000. Now, let's assume that all your other details are exactly the same, but your taxable income is $250,000. Now your adjusted income before super contribution is above the threshold, so you will have to pay tax on the entire amount of your super contributions. Division 293 has been around for quite some time. It was first introduced in the 2013 federal budget by, well, you guessed it, the Labour government. It came nicely wrapped as a measure to make the superannuation system more fair for everyone. The idea was to reduce the tax benefit high-income earners are getting from having some amounts of their income concessionally taxed inside the superannuation system. If you're a high-income earner, your marginal tax rate is 47%, including Medicare. But when your super contributions are only taxed at 15%, you get a tax concession of 32% from the super system. In comparison, someone on a marginal tax rate of 34.5% will only get a concession of 19.5%. The government thought it was unfair and wanted to reduce the gap by taxing super contributions of high-income earners at 30% instead of 15%. I still fail to see how this would benefit someone on a lower income. Initially, when the measure came out in 2012, it was set to apply to individuals earning over $300,000 a year. And in those days, that level of income was quite high. But the problem is, when the government introduced the legislation, they conveniently forgot to incorporate indexation of the threshold for the inflation factor. They do it every time. And then, subsequently, in 2017, the threshold was reduced to $250,000. By the way, we can credit the Liberal government for that. And with ever-rising costs of living, inflation, indexation of wages, and increase in super guarantee rates, gradually more and more people will be affected by it. A $250K per year is a fairly moderate income by today's standards. I guess if the measure was introduced today as it is, it wouldn't be very popular. Okay, there is no point complaining. Let's now jump to frequently asked questions about Division 293 tax. Can I do anything to avoid or reduce Division 293 tax? The only viable strategy to reduce your Division 293 tax exposure is to plan around the timing of your personal contributions. If you are consistently earning way above the threshold, your option will probably be quite limited. However, if your income tends to fluctuate from one year to another, or if you are able to manipulate the timing of your income, you have more planning opportunities available to you. Planning for Division 293 tax should be a part of the overall tax strategy. It shouldn't be taken out of the context. Is it still beneficial to make tax-deductible personal contributions when Division 293 tax applies? Yes, it is. Even if the contribution itself is taxed at 30%, when your marginal tax rate is 47% including Medicare, you are still saving 17% of the contribution amount, so it is still tax effective. Does Division 293 tax apply to non-residents and temporary residents? Yes, Division 293 tax applies to everyone with adjusted income over the threshold amount, irrespective of their residency status. However, if you withdraw your super as a temporary resident departing Australia, you will get a refund of your Division 293 tax. Is Division 293 tax payable on the excess super contributions? No, when you exceed your available concessional contribution cap, the concessional tax treatment of the excess is effectively reversed, and the amount no longer counts as your concessional contribution. So Division 293 tax is not payable on the excess. How to pay Division 293 tax? To pay Division 293 tax, you have two options. You can either pay directly out of your own funds, or you can choose to release money from your super to pay for it. There are no particular tax benefits to either of the options. The choice should really depend on your current priorities and cash flow situation. If you choose to pay it out of your super, you must complete an election form to notify the ATO of your choice within 60 days from the date of your Division 293 assessment. The payment due date and the cut-off date for making an election will be stated on your assessment. Why didn't my accountant tell me about my Division 293 liability? There could be a few reasons. Division 293 tax is not part of your tax return. It's a separate assessment issued directly by the ATO based on the information reported to them by super funds, bypassing your accountant. If the scope of engagement with your accountant was only limited to completing a tax return, they probably won't even bother telling you about Division 293 tax. Even if you work with a regular advisor, often they don't have enough information to give you an accurate prediction of your Division 293 liability, but they should at least inform you if it's likely to apply to you. As medical professionals tend to be high-income earners, a lot of doctors encounter Division 293 tax as they reach a certain point in their career. So if this is your first Division 293 tax assessment, congratulations, you've made it. Welcome to the club. If you want to learn more about Division 293 tax, check out the link to the article in the description.